On December 15, 2025, an internal SpaceX tender offer cleared at $421 per share. The implied valuation was $800 billion. 4 months later, according to data posted by Forge Global, the same shares were quoted on a private secondary market at $936, a markup of roughly 122%. In a company that has never filed an S1, never published an audited financial statement, and whose retail shareholders, as of this recording, number exactly 0. In this same window, a Nasdaq rule change quietly took effect. A change Michael Burry, the investor who shorted the American housing market in 2007, described in a public post as the most shameless structural manipulation of a major index he had ever witnessed. The rule was not written for SpaceX, but it functions in operation as if it were. In this episode, we find out how the architecture of the SpaceX IPO was built not on the trading floor, but in the 4 years before it. Through tender offers the public was never invited to, an act of Congress that quietly raised the disclosure ceiling, and a single rule change at the Nasdaq that turned the listing itself into a mandate to buy. To understand how shares can be marked up 122% in a market the public cannot enter, you have to start not with the rockets, but with a mechanism. The SpaceX tender offer, a structured, twice-yearly liquidity window in which existing employees and early investors are permitted to sell a portion of their holdings. The buyers are a curated pool: late-stage funds, sovereign wealth investors, crossover hedge funds, at a price the company itself sets. A tender offer, in plain terms, is a structured buyback. The company picks the price. The company picks who can buy in. Retail is not on the invitation list. The company itself was founded in 2002. The first Falcon 1 reached orbit in 2008. Starlink, the satellite internet business now subsidizing the rocketry, turned operationally profitable in 2024, generating, by figures reported in Bloomberg, roughly $4.42 billion in operating profit. That number is significant. It is the asset that turned the tender offers from a perk into a market. And here is the facade. SpaceX, the company will tell you, is fully transparent to its investors. Per the public record on SEC EDGAR, the company has filed more than 50 Form D notices, raising over $15 billion in disclosed capital. The implication is reassurance. The reality, as we'll see, is that a Form D is a one-page exempt offering notice. It contains no audited income statement, no balance sheet, no risk factors, no segment breakdown. Nothing a public company 10K would require. By 2024, the tender offer was no longer a perk. It was a product. And the product, having grown to the scale of a small national economy, needed a market. The question for any private company that has crossed the $800 billion threshold without a single share trading on a public exchange is not whether you go public. It is who you let in when you do. In April of 2012, the United States Congress passed the Jumpstart Our Business Startups Act, the Jobs Act, marketed almost universally as a small business job creation measure. Inside it, however, was Section 502, a provision raising the Section 12G mandatory SEC registration trigger from 500 holders of record to 2,000 or 500 non-accredited investors, whichever came first. Section 12G is the line in the sand of American securities law. Cross it, and you must file the same audited statements every public company files. In 2004, Google reached that line. 500 holders of record forced to go public. SpaceX, under the post-2012 rule, has thousands of beneficial owners and remains private. Not because the company is smaller, because the threshold was moved. The mechanism that absorbed the additional capital is called the Special Purpose Vehicle, the SPV, a single-purpose legal shell, one entity, one holder of record on the SpaceX cap table, but inside it, dozens, sometimes hundreds, of beneficial owners. For more than a decade, SpaceX's secondary market has been intermediated by precisely these vehicles. The headline count of holders of record stays comfortably beneath the 2,000-person ceiling. The underlying universe of beneficial holders does not. According to the SEC EDGAR archive, the cumulative capital raised through this exempt offering framework now exceeds $15 billion across more than 50 Form D filings. $15 billion, 0 audited 10Ks, and quietly, layered beneath this, sits the third architectural feature, the dual-class voting structure. Per reporting derived from SpaceX prospectus drafts circulating among late-stage investors, Elon Musk holds approximately 42% of the company's equity, but between 79 and 85% of the voting power through Class B supervoting shares carrying 10 votes apiece. The structure mirrors Google's 2004 architecture exactly. The facade here is the most resilient of the three. The facade is that an IPO transfers control of a company to its public shareholders. It is the foundational assumption of equity capitalism. As we'll see in a few minutes, that assumption is now structurally optional. By the spring of 2026, the regulatory perimeter was no longer the problem. The perimeter had been redrawn. What remained was the listing itself, and that too was about to be re-engineered. Not by the company, by the exchange. May 1st, 2026. The Nasdaq rule change formally takes effect. Standard practice for index inclusion. A newly listed company must season for 12 months, roughly 252 trading days, before becoming eligible for the Nasdaq 100. The new rule, formally titled Fast Entry, reduces that window to 15 trading days for any listing in the top 40 by market capitalization at IPO. Index inclusion is not a marketing event. It is a mandate. Trillions of dollars in passive funds, QQQ, the indexed allocations inside hundreds of millions of American 401k accounts, are contractually required to buy any name added to the index in proportion to its weight. The longer the seasoning window, the more time for price discovery before that mandate hits. Compress the window from 12 months to 15 days, and the IPO ceases to be a price discovery event. It becomes a price-setting event. Insiders on the sell side, the passive complex on the buy side. Enter Michael Burry. In May of 2026, in a public post, he stated, verbatim, "The most shameless structural manipulation of a major index I have ever witnessed. The rule was not written for the public, it was written around the public." Burry's framing is structural, not anecdotal, and it lands at the moment a second anomaly becomes impossible to ignore. The Destiny Tech 100, a publicly traded closed-end fund holding pre-IPO SpaceX exposure as roughly 14 to 16% of its portfolio. In 2025, per Destiny Tech 100's own filings, the fund's net asset value, the value of its underlying holdings, climbed 209.59%. In the same calendar year, its market price on the exchange fell 47.96%. The asset went up. The thing the public could actually buy went down. by nearly half. 2 prices, 2 rule changes, 1 company. The pieces, on their own, are unremarkable. The arrangement of them is the story, and once you see the arrangement, you cannot unsee what it does. The architecture assembled, piece by piece, in plain sight. Google was forced public in 2004 because it had crossed 500 holders of record. SpaceX in 2026 has thousands of beneficial owners and remains private, not because the company is smaller, because the threshold was moved and the SPV was permitted to consolidate hundreds of beneficial owners into a single line of record. 50 Form D filings, $15 billion raised, 0 audited financial statements. Every figure in this documentary that originates inside SpaceX is, by necessity, a number leaked, a number tendered, or a number inferred. Read the loop slowly. Fast entry compresses seasoning. Supervoting shares preserve insider control. SPVs preserve cap table opacity. The IPO clears at a price calibrated against tender history, not against open market price discovery. Passive funds, by mandate, absorb the float. The retail investor, through their indexed 401k, through their QQQ allocation, through their pension fund's passive sleeve, is contractually committed to the buy side. They will not be asked. They will be filled. If the underlying holdings appreciated 210% and the public market price collapsed by half, the answer is not that the asset failed. The answer is that the access premium, the amount retail was willing to pay above net asset value for any exposure at all, was the bubble. The asset tripled. The premium evaporated faster. The asset was never the bubble. The access was. Which brings us to the single figure that compresses the entire structure into a sentence. Read it once, then read it again. For every dollar the public will eventually pay for a SpaceX share, insiders have already cleared between $2 and $7 of paper wealth through 6-month tender cycles the public was never invited to. An IPO, in the public imagination, is the moment a company belongs to its shareholders. With a 10-vote per share supervoting structure mirroring Google's 2004 architecture, the SpaceX IPO will transfer economic exposure to the public. It will transfer voting control to no one. The Class A holder, the public, the indexed pension, the QQQ investor, owns the consequence. The Class B holder owns the decision. Burry's post did not move markets in the conventional sense. It moved the desks. Within 72 hours, the fast entry analysis appeared in the Financial Times and on the Bloomberg terminal. Academic finance, characteristically slower, followed within the month. The strongest formulation came from a name most retail investors will not recognize, but every IPO underwriter does. When the index inclusion mandate is severed from price discovery, the IPO ceases to be a market. It becomes a transfer. 2 large state pension systems, citing the supervoting structure and the absence of audited statements, formally flagged early concerns about mandated passive exposure. The pensions cannot opt out of the index. Their members cannot opt out of the pensions. The SEC's Division of Corporation Finance is reported to be reviewing the SPV beneficial ownership question, the precise mechanism by which the Section 12G holder count has been kept below 2,000. No enforcement action has been announced. The review itself is the signal. Meanwhile, the counterparty side of the tender market has only deepened. Saudi Arabia's Public Investment Fund, Mubadala, GIC, documented participants, per reporting in the Financial Times and Bloomberg. in the 2025 tender cycles. Deep-pocketed buyers who do not need a Nasdaq listing to clear their position. By April 15, 2026, Forge Global was reporting SpaceX at $604.39 per share, a $1.03 trillion implied valuation. The tender offer insiders, early employees, late-stage funds, sovereign wealth participants have already crystallized their position. The public, when its turn comes, will arrive at a price already set. The fallout, in the conventional sense, has not yet arrived. The listing itself has not arrived. What has arrived is the map. And once a map is published, the territory rarely surprises anyone who bothered to read it. Step back from SpaceX. The pattern is not the company. The pattern is the architecture around it. Every major piece of post-2008 capital markets reform, the Jobs Act, Regulation A+, the secondary tender ecosystem, the index fast entry rules, the August 2025 executive order directing the SEC to facilitate alternative asset access for retirement plans was sold to the public as democratization. Each one, examined empirically, has functioned primarily as a liquidity pathway for capital that was already inside the room. Each one widened the back door before anyone thought to widen the front. This is not, to be precise, a moral indictment of SpaceX as an engineering enterprise. The Falcons land. The Starlink constellation works. Starship matures. The cynicism is not directed at the company. It is directed at the structural framework around it. The rocket is real. The auction around the rocket is the artifact. The two-tier market is now the default state of American equity capitalism. The first tier sets the price. The second tier inherits it. The first tier is where capital is formed. The second tier is where it is distributed. At a markup, the first tier has already collected on. The transaction is the same. The participants are not. There is a quieter observation buried inside this. The retail investor in 2026 has more apps, more brokerages, more zero-commission trades, more fractional share access, and more direct-to-phone market data than any individual investor in the modern era. And on the assets that actually compound, the pre-public, the alternative, the structured, fewer points of entry than at any time in living memory. The trading window has never been wider. The investable universe has never been narrower. If the listing of the largest private company in American history clears at a price already set, by tenders the public could not see, in a window the index cannot wait out, under voting shares the public cannot outvote. The question is not whether the market is rigged. The question, quieter and far older, is what we have agreed to call a market in the first place.